Hello and welcome to this fresh new edition of Mutual Fund YouTube Corner. We make everything accessible and get expert advice for you on this edition. And today we are going to be speaking all about mutual fund investing and risks associated with it. And we have our expert joining us. We welcome Prableen Bajpai, who's the founder at FinFix Research and Analytics. Prableen, thank you so much for joining us. Always a pleasure speaking with you. We speak about returns that investing could get you, but there are a lot of risks associated with it as well. So let's kickstart the conversation with that. How important is it to assess risks associated with mutual fund investing? Name some of them that we can tell our viewers, and then we'll dig deeper.
Right. Hi, Sonal. Great to be here with you on the YouTube edition. Yes, returns, I think we all chase, and risk is something we don't want to really talk about and discuss at times, especially when the markets are booming, because that is the time when returns become the focus area. And the opposite also happens, Sonal, when the markets are not doing well, when the stock markets are down, it is the risk which gets highlighted. But I think we still only look at the market risk that the markets have fallen. A number of different kind of risks are often ignored by investors. But broadly, risk and return are two sides of the same coin. And in finance, we believe that the higher the risk, higher should be the return. And it means that if you are undertaking a higher risk, the return prospects from the outcome should be better, so that you're compensated for the higher risk which is being taken. And taking informed decisions for investors is of utmost importance, because that is, where they are able to match their own risk appetite, their own risk profile with the suitability, for better suitability with the risk that they're undertaking. And, when we're looking at portfolio creation, it is not only the outcome in terms of returns. Every portfolio has a risk attached to it, and that risk must match and the comfort level of the investor, and that is why it needs to be assessed. And the broader risks when it comes to mutual funds are, of course, the market risk, the credit risk, liquidity risk, fund selection risk, we look at concentration risks. So these are broadly the risks, I think, which are of importance for investors to understand.
Okay, thank you so much for that concise answer. It'll help the viewers as well. But, apart from the standard risks associated with mutual funds, and we, of course, have discussed that in your answer as well, fund selection risk, a newer one. What is it that the investor should be aware of in this case?
Right. So we all want to buy the best mutual fund scheme, and which is giving the highest and the best returns. So that's one objective as an investor. And we are also investing in active funds so that we can beat the benchmark index. So for a large cap fund, the benchmark is usually Nifty 100. So as a large cap fund investor, I want to be able to invest in a fund which is giving me more returns than Nifty 100. Now, so with time, what we've seen is that we have these active funds and also the passive funds. So the active funds, because we are looking at higher returns, our objective is only met, and the risk that we are undertaking in investing in an active fund is only justified when my fund is able to beat the benchmark. But what we are seeing is, as the mutual fund categories have now been very tightly demarcated and defined by SEBI, and the universe from where they can invest is also very tightly packed, the outperformance is, is becoming narrower. So, a lot of reports actually tell us where, especially in the large and now increasingly in the mid-cap space also, the active funds are not able to beat the benchmark. And that creates the fund selection risk. How do you choose the right fund which will actually beat the benchmark? So, on a 3 or 5 year basis, the underperformance for active funds is as high as 93 to 96%. On a 10-year basis, it is about 67%. So this creates a different kind of a risk for an investor. And also the divergence of returns between the best and the worst performers within the category. For example, on a 7-year, annualized returns basis, the best large cap fund is given 15.12% returns, and the worst is given only 8.78%. Although that person is also undertaking a higher amount of risk. So this is the kind of risk investors need to watch out for. And during the same time period, the index returns, Nifty 100, were about 13%. So this is a newer kind of risk that we are seeing in the industry. And I think this is something that investors definitely need to, be aware about while investing.
Okay, so that's an interesting viewpoint that you have given us as well, because there's been a rise in passive investing as well. But Prableen, let's drill it down to the individual risk that you were speaking about earlier as well. Because when a sector does well, it does happen that people go ahead and invest entirely in that particular sector. So does it still create a concentration risk if that particular segment is doing well? Is it easy to pull out money from there in case you're feeling that, okay, this sector is not doing so well, so I can move my money somewhere else?
So this actually starts with recency bias, Sonal. That we want to look at the past returns, and we feel that okay, now this has given 70% returns, this sector has given like 55% returns, and this is where I should be. So somewhere the decision making actually starts at a wrong note, because somewhere we are tempted by the returns which is we are seeing in the past, and this has happened actually with a technology sector. If we look at during COVID times, during 2020 and 2021, the returns from IT sector were absolutely brilliant, and so were from the healthcare. And now in 22 we saw that there was a correction there. So when an sector is doing well, I think it would create a lot of risk for investors' portfolio if you're going and investing in that sector, especially when it's already done well. One should actually take exposure probably when there is some correction, which of course requires a different kind of an approach. But definitely investing at the highest levels creates a different level of risk, and also concentration risk, because all those stock holdings within that portfolio are going to be from that sector. But if that allocation is restricted to, let's say, within 5% of your overall portfolio, maybe you can withstand that kind of a concentration and that kind of a high risk investment as well, but not beyond that. And one more thing here, Sonal, that within the sectors, there are certain sectors which are slightly defensive, let's say consumer products, FMCG products. So even if, there is recession, depression, one would still have a biscuit and, brush your teeth and have coffee. So, we call them defensive stocks, while, there are other sectors where we see a sharper correction in times of recession or in times of, rising interest rates. So I think the sector that we choose also is very important. But definitely it comes at high risk, and sectoral investments are not for everybody, must be understood and then only invested in.
Oh, yes. So, and any expert advice like yours would be needed in times of sectoral investment as well, right? But, it boils down to one thing. Investors would need guidance as to how to combat the risks which are associated with investing, because that will continue to remain. In that case, what should they do?
So I think first thing that they need to understand is that market risk will always be present. So while it is present, they have to, based on that, the risk that we will be able to withstand during times of a market meltdown, that is the amount that they need to put in equities, and thus the investment horizon there has to be very long. So once they have the right investment horizon, they can choose the right asset class, and then they are comfortable with their equity investments. So having clarity on those two things, Sonal. Secondly, this again comes down to maintaining the right asset allocation. So once you've chosen your equity allocation, then you know how much goes into fixed income, how much goes into gold, what is your real estate portfolio. So having the asset allocation table laid out right in front of you is very crucial, which we often don't do. Another very important thing is that, like I said, matching your own risk appetite, your own risk profile with your overall investments. It's okay, equity portfolio will always carry higher risk, but then that is mitigated by the fixed income that you're holding. So the overall risk of the portfolio should match your comfort level in terms of risk. And finally, be aware of any biases that may be sort of, making you take investment decisions which are not, very correct for your long-term portfolios ahead.
Okay, all right. That's a precise summary of everything that one should know. Thank you so much, Prableen, for joining us today and making sense and making our viewers aware as well of the various risks which are associated with mutual fund investing. We'll be speaking to you soon again, but thank you for joining us today.
Thanks so much. Thank you.
Okay, all right. With that, we'll take your leave on this edition of Mutual Fund YouTube edition. Stay tuned for more updates.